Ever feel like you're just drowning in information? Articles, reports, research, it's everywhere, right? And it's so easy to feel overwhelmed. Like you need someone to just translate it all.
Yeah, information overload is real.
Well, consider this your navigational chart. Our mission here is to be that shortcut. We extract the vital insights from really dense material.
So you can be genuinely well-informed without spending days reading.
Exactly. And for this deep dive, we're tackling something that, okay, on the surface might sound a bit dry, a quarterly financial report.
Right, specifically a Form 10Q. This one's from a massive, globally operating financial institution.
But trust me, these aren't just like boring numbers. These documents, they're kind of like blueprints to a colossal ship.
They show its design, its health, its strategy.
And the stormy waters it navigates every single day.
Yeah.
Our goal today is really to peek into the engine room of this financial giant.
We're going to uncover the big picture. What does this company actually do?
Right. How does it power itself, make and manage its money? What are the big risks it faces?
And where is its compass pointing? Where is it headed?
Okay, so let's start there. You mentioned its scale. The SEC calls it a large accelerated filer. What does that actually mean for us?
Basically tells you it's a major publicly traded company, one of the biggest. They have to file their financials electronically regularly.
Got it. And it's not just some empty shell.
Oh, no, absolutely not. You're getting a look at a fully operational, really substantial entity here.
And when we say colossal, we really mean it. Just to put a number on it. As of late July 2025, this company had over 665 million shares.
That's products for companies and their employees. Think life insurance, dental, disability coverage, that sort of thing.
Right.
Then there's RIS. That stands for Retirement and Income Solutions.
Yeah.
Also U.S.-based.
And what do?
They offer life and annuity-based insurance and investment products, but more for corporations and institutions. Things like stable value funds, pension risk transfers.
Okay, institutional stuff.
Exactly. Then beyond the U.S., they have a really big international footprint.
Right.
They're Asia, Latin America, and EMEA segments. It's Europe, Middle East, Africa. They each offer a broad range of products: life, health, retirement, savings for individuals and companies.
So a lot of overlap in product types across regions.
Yeah, but tailored to those specific markets, you know. And finally, there's MetLife Holdings.
MetLife Holdings. What's that?
That's mostly managing older products, primarily from their U.S. business, that they aren't actively selling anymore.
Like legacy stuff, old variable life policies, maybe long-term care.
Precisely. Stuff that's still on the books and needs managing.
That diversity across products and geographies, that's not just a list, is it? It feels like a strategic shield.
That's a great way to put it.
The core insight here, for you listening, is that by operating across so many different markets and product lines, this company is just inherently more resilient.
Exactly. If one area slows down or one product hits a snag, another might be doing well. It's like a built-in shock absorber.
Right. Against localized economic issues.
And, in terms of how they measure their own performance, they focus on something called adjusted earnings.
Adjusted earnings? Is that just accounting jargon?
Well, it's their way of looking at the underlying profitability. They try to set aside the noise from market volatility.
Noise like
Sudden swings in investment values or gains and losses on derivatives, stuff that bounces around a lot.
So it helps them and us see the more consistent operational performance.
That's the idea. Yeah. They also use an internal economic capital model. Think of it like an advanced risk radar. It helps them measure risk across the whole business and make smarter decisions about where to put their capital.
Okay, so we've got a handle on what this company does. It's global reach. Now let's talk about the fuel. How do they actually generate revenue? What's the income picture look like?
Well, their total consolidated revenues for the second quarter of 2025, we're looking at $17.3 billion.
Wow, okay.
And for the first half of the year, $35.9 billion. The main sources are pretty standard for insurance: premiums, policy fees, income from their investments, and some other revenues.
Any big shifts there?
Well, premiums for Q2 were $10.8 billion. That was actually down a bit from $11.6 billion the year before.
Okay.
And it's important to remember components like net investment gains or losses. And those derivative gains or losses, they can be pretty volatile. They swing with the markets.
Right. Tied directly to market ups and downs. Now, this is where I think it gets really interesting. A company this huge, with all these reserves, how do they actually invest all that money? What are the big buckets?
Yeah, this is key. They operate with very disciplined asset liability management principles.
ALM.
ALM.
Sounds complex.
Think of it like this. They carefully match the timing and amount of cash coming in from investments to the timing and amount of cash they'll need to pay out on policies later.
Okay, matching inflows and outflows.
Exactly. Ensuring they can always pay claims. And their portfolio is heavily weighted towards steady income-producing assets, mostly fixed income.
Fixed income, like bonds.
Right. Their biggest chunk, almost $300 billion, is in what they call fixed maturity securities available for sale.
Okay.
Imagine a giant basket of generally high-quality debt, U.S. and foreign corporate bonds, government securities, mortgage-backed securities, asset-backed. They spread it across a wide spectrum.
Trying to get consistent income.
That's the goal.
Yeah.
And actually, they saw their unrealized losses on these decrease by about $2.1 billion in the first half of 2025, mostly because interest rates came down a bit.
Oh, okay. What else is in the investment mix?
Next up are mortgage loans, a really substantial portfolio of about $86.8 billion.
Mortgages on.
Mostly commercial properties, then agricultural properties, and some residential loans too.
How do they make sure those are good quality loans?
They look closely at a couple of key metrics. One is the debt service coverage ratio, or DSCR.
Oh, yes, CR.
Yeah, basically asks, how much income does the property generate compared to its loan payments? Higher is better, means more cushion.
Got it.
The other is loan to value, or LTV. How much did they lend versus the property's actual worth? Lower LTV is safer.
And their numbers look good on those.
Very good. For example, over 80% of their commercial loans have a DSCR above 1.2x, which is healthy. And almost 93% of their farm loans have an LTV under 65%. It points to prudent lending.
So the vast majority are performing well.
Yep, 98% of all their mortgage loans are performing. It's a high-quality portfolio.
Okay. What else?
They also hold real estate and real estate joint ventures. That portfolio actually saw a nice $3.8 billion unrealized gain in the first half of 2025.
Nice.
And then there's a category called other invested assets. This is where you find some more unusual stuff.
Like what?
Like tax equity investments, often in things like low-income housing projects or renewable energy partnerships.
Interesting.
And also company-owned life insurance policies, known as CLI. That's about $1.8 billion.
Wow. Okay. That's a huge global spread of investments. With all those fixed income holdings, bonds, and such, are there any big geographic concentrations? Where are they holding these sums internationally?
Yeah, good question. Within those fixed income securities, they do have concentrations of credit risk in certain foreign governments.
Meaning they hold a lot of debt from specific countries.
Exactly. As of June 30, 2025, the big ones were Japan at $18.6 billion, South Korea at $6.7 billion, and Mexico at $4.0 billion.
Okay. Any others?
They also hold smaller amounts in places like Israel, Ukraine, and the Russian Federation.
Got it. And you mentioned derivatives earlier. How
Yeah.
do they fit into this investment picture?
Right, derivatives. They use these extensively to manage risk. Think protection against swings in interest rates, stock markets, foreign currency exchange rates.
So financial contracts designed to offset potential losses.
Pretty much. Some are formally designated as hedges for accounting purposes, offsetting specific risks. Others might be used for broader portfolio management, or even to synthetically create certain investment exposures they want, like custom-made tools.
So, if I'm understanding this, these complex tools of derivatives, they really do act like that financial shock absorber you mentioned, aiming to smooth out the bumps from market swings.
That's a perfect way to think about it.
Yeah, especially for that adjusted earnings figure.
They focus on making it more predictable.
Exactly. They aim to reduce the impact of market volatility on their reported earnings, giving a clearer picture of the core business.
Okay.
Absolutely, it's a core promise, and it's massive. Their net liability for SPVs, even after reinsurance, was nearly $66 billion at the end of June 2025.
Wow. $66 billion set aside.
Yeah. And it's interesting, for some specific types of contracts, like single premium annuities, the initial reserve they have to set up can actually be more than the premium they received.
How does that work?
It's an accounting thing.
Yeah.
It creates an immediate loss at issue. Then, if the policy
Performs better than expected later, that gain is recognized over time.
Huh. Complex.
It is. And the time horizons vary wildly, too. The average duration for their RIF
belongs to the customers, but it's sitting with the company, almost like a very secure savings account that's earning interest.
Okay, so funds held for policyholders.
Right, earmarked for future payouts or withdrawals. And the total is staggering, $232.4 billion at June 30, 2025.
$232 billion. Where does most of that sit?
Well, big chunks are in things like their RIS capital markets products and stable value funds. That's about $66.5 billion. And their Asia Universal Life type products hold another $53.5 billion.
And that balance is constantly changing.
Constantly. Deposits come in, people surrender policies or take withdrawals, benefits get paid out, interest gets credited. It's very dynamic.
Okay, now this next one sounds particularly interesting. Market risk benefits. They sound like a complex balancing act. What are they?
Yeah, MRBs, or market risk benefits. These are basically guarantees the company makes on variable annuity contracts.
Guarantees.
Like promising a minimum payout upon death or a minimum income stream in retirement, even if the underlying investments don't perform well.
So protection against market downturns for the policyholder.
Exactly. But valuing these liabilities on the company's books is incredibly complex.
Why is that?
Because it depends on so many things. Market conditions, obviously interest rates, stock market levels, volatility, but also actuarial assumptions, like how long people will live or how likely they are to lapse their policy or use the benefit.
And they factor in other things too.
Yeah, they even adjust for their own creditworthiness. That's called non-performance risk, and they add risk margins as extra buffers.
So for us listening, the key thing is these are really sensitive.
Extremely sensitive. Even things you might think are good, like higher interest rates or just okay stock market gains instead of huge ones, can actually hit the valuation of these guarantees negatively on their books.
Wow. Counterintuitive. Okay. What about plain old debt?
Yep, they have that too, of course. Debt and other financial obligations. This includes long-term debt of about $15.3 billion and subordinated debt of $4.1 billion. These are fundamental to their capital structure.
And they're still accessing the debt market.
Oh, yeah. Just in March 2025, they set up a new facility to potentially issue up to $1.25 billion in new senior notes. Shows they have ongoing access to capital.
Okay, so we've looked at money in, money out, liabilities. Let's pivot now to strategic moves. How is this colossal ship charting its future course, navigating the industry landscape?
Looking ahead.
Beyond the day-to-day, what major strategic plays are they making to grow and evolve? Any big acquisitions or anything?
Yes, actually. A significant move mentioned is the pending acquisition of PineBridge Investments.
PineBridge, what do they do?
They're a global asset manager.
The plan is for them to become part of MetLife Investment Management. It's expected to close by the end of 2025.
How's the deal structured?
It's about $800 million in cash at closing, plus potentially another $200 million.
More assets, maybe get more fee income.
That's exactly the play. Expanding capabilities, diversifying revenue streams.
Makes sense. Now, how is the broader world affecting them? The global economy, politics?
Oh, profoundly. The report talks about the ongoing impact of things we all see. Global inflation, supply chain issues, geopolitical conflicts, acts of war, volatility in the banking sector, shifts in employment policies.
Yeah.
It all feeds through.
So what does that actually mean for us, the listener? How do changes in, say, interest rates set by the Fed or
Government policies overseas ripple down to a company like this?
Well, it hits them directly because they're so big, so global, with that huge investment portfolio and those sensitive liabilities and derivatives we talked about.
That must be a huge factor.
Absolutely. It's a constantly shifting landscape.
Yeah.
There have been several significant developments they have to navigate.
Like what?
One is the DOL fiduciary rule. The Department of Labor tried to change the definition of who's a fiduciary when giving retirement advice. It impacts financial pros, including insurance agents.
I remember hearing about that. What's the status?
It's kind of in limbo. Federal courts put it on hold in July 2024, and the DOL says they'll revisit it. So there's uncertainty about when or even if
It will take full effect.
Okay, regulatory ambiguity. What else?
Another big one is the Chile pension reform, a bill passed in March 2025 that introduces some major
What's on the regulatory front?
Just briefly, the SEC recently stopped defending its climate-related disclosure rules, which adds some uncertainty there. And there are new rules coming about clearing U.S. Treasury trades.
Clearing treasury trades.
Yeah, requiring more trades to go through a central clearinghouse, cash trades by late 2026, repo trades by mid-2027. The market effects are still uncertain, but it's a big operational shift for those markets.
Wow. It really underscores the constant complex navigation required, a dynamic regulatory environment for sure. But this raises another point. How much of what we're seeing in this report relies on judgment and estimates, not just hard facts?
That's a really critical point for any financial report. And they're upfront about it.
How so?
The document explicitly identifies 8 areas that require subjective and complex judgments and have inherent uncertainty.
8 areas, like what?
Things like calculating those future policy benefits and market risk benefits we discussed, estimating the fair values of certain investments and derivatives, accounting for potential credit losses on loans, valuing goodwill from acquisitions, estimating pension liabilities, income taxes, potential litigation costs.
So a lot of key numbers involve significant judgment.
Yes, while the reports are full of precise-looking numbers, for you listening, it's crucial to remember that a significant degree of management judgment and estimation is baked into those figures.
Good reminder. Okay, let's shift to financial endurance. How do they make sure they can weather any storm? Let's talk liquidity and capital.
Right, their staying power, their liquidity position looks robust. As of June 30, 2025, their short-term liquidity, cash, and very easily convertible stuff was $21.5 billion.
Okay, readily available cash.
And their broader measure of liquid assets, which includes publicly traded securities they could sell quickly, was $183.3 billion.
That sounds like a lot. So they have cash on hand, but how do they rigorously manage their capital, make sure they always have enough, especially if things get tough?
They have a very robust capital management process. It involves senior management committees like a capital management committee, an enterprise risk committee.
So dedicated groups looking at this.
Exactly. They constantly review capital levels under various stress scenarios, literally simulating worst-case situations.
Okay.
They approve an annual capital plan, which then goes to the board of directors for final approval. The whole goal is maintaining financial strength and those crucial high credit ratings.
Which they need to operate and keep trust, right?
Absolutely. It's fundamental.
So where does the money come from and where does it go? Sources and uses of cash.
Primary sources include cash from their core operations that generated $6.4 billion in the first half of 2025. Also, a net increase in those policyholder account balances we talked about brought in $4.0 billion.
So policyholders putting money in, basically.
Right. And they also issue debt sometimes, like that $1.2 billion in subordinated debt back in March.
Okay, and where does the cash go? The primary uses?
Big uses include investing activities. They deployed a net $6.3 billion there. They also spent $1.9 billion buying back their own shares in the first half of 2025.
Share repurchases, okay.
And paying dividends, both on common and preferred stock, that totaled about $853 million.
So if we connect this back to our ship analogy, this is how they
Manage the day-to-day finances, keeping the fuel tanks full, engines running, investing in new voyages, and returning some profit to owners.
That's a perfect summary. And one final detail on that. Exactly. But those dividends are subject to strict regulatory limits, both in the U.S. by state regulators and internationally. It's usually based on the subsidiary's prior year profit or surplus, ensuring the operating companies stay financially strong.
Got it. Okay, final section. The unpredictable. Risks and contingencies. Every report has this section, right?
Oh, yes. The part where they tell you what could go wrong. It starts with forward-looking statements.
The standard disclaimer.
Pretty much. They state clearly that the report contains projections about the future, but these aren't guarantees. They're subject to unpredictable risks and uncertainties.
What kind of risks do they list?
Usual broad categories: economic conditions, interest rates, credit spreads, stock markets, even climate change impacts, global capital market problems, legal and regulatory changes, litigation, technology changes, catastrophes, cybersecurity failures. The big stuff.
This is that big disclaimer. Yeah, but it's important, right? It's a reminder of all the uncertainties out there for any huge business.
Absolutely. It shows they're thinking about potential headwinds beyond just the numbers in the report.
Do they mention any specific current legal issues?
They do. They detail a few ongoing matters. One is Total Asset Recovery Services, LLC v. MetLife, Inc.
What's that about?
It's a type of lawsuit called qui tam, brought under the New York False Claims Act. It alleges the company filed false unclaimed property reports going way back from 1986 to 2017, supposedly to avoid handing over life insurance proceeds that should have gone to the state.
And where does that stand?
The trial court denied their motion to dismiss it back in October 2024, so it's an ongoing legal battle.
Okay. Anything else significant?
There are also ongoing inquiries from regulators starting back in 2018 related to a material weakness they had identified in how they estimated reserves for certain group annuity benefits.
Material weakness. That sounds serious.
It means their internal controls weren't effective in that specific area. It could potentially lead to more lawsuits or payments down the road. And finally, they acknowledge asbestos claims. They state that their total exposure might be materially greater than what they've currently reserved for.
But they don't think it will cripple them.
Right. They say future charges may be necessary, but management believes it's unlikely to materially affect the company's financial position. So, acknowledging risk, but expressing confidence.
Okay. And what about other promises, like guarantees?
Yeah, commitments and guarantees. They mention they provide various indemnities, for example, covering potential tax or environmental issues when they buy or sell businesses, or indemnifying their own directors and officers.
Standard practice for big deals.
Pretty standard. But many of these guarantees don't have a specific dollar limit, so they say it's impossible to determine the absolute maximum potential amount they could owe.
But they don't expect major payouts.
Correct. Management states they believe it's unlikely the company will have to make any material payments under these agreements.
That sounds like the necessary legal boilerplate, almost, for operating in such a complex global environment. Standard stuff for doing business at this massive scale.
Covering their bases.
Okay. Well, today we really took a deep dive into hundreds of pages of financial reporting. We tried to strip away the jargon.
Yeah, get to the core.
To reveal the intricate workings of this global financial institution. We looked at its huge range of businesses, its complex investment strategies.
The massive liabilities it manages for policyholders.
Its strategic moves to grow, like that Pine Bridge deal, and the constant economic and regulatory pressures it faces.
A lot to navigate.
It really is. But thinking about it all, what stands out most to you listening, beyond just the numbers, maybe consider how that interplay of global trends, new tech, shifting regulations, how it creates this constantly evolving landscape, even for the most established giants.
Right.
How do those external pressures really shape a company's ability to innovate, adapt, and ultimately, deliver on its long-term promises? Something to think about.